may not be a typical definition for a responsible investor across the investor community, but I'd like to say that if you think about the United Nations Principles for Responsible Investing, so the UNPRI, I think most investors could acknowledge and align around their definition of responsible investing. And they define responsible investing as any investment strategy that explicitly includes environmental, social, and governance factors into the investment process in trying to mitigate risk or in trying to increase long-term sustainable rewards. I think that's a pretty good definition. The UNPRI has been around for over 10 years. They have over 1,500 signatories from asset owners and asset managers who've agreed to sign up to these voluntary principles. So I think people can coalesce around that. And the way I kind of personally look at the space is that I'd say responsible investing is almost like the umbrella. It's almost a catch-all for the various different strategies and subsectors, if you will. So responsible investing is the umbrella. And then to come on to your question about sustainable or impact or ethical investing, I think my experience with wealth managers and index providers and asset owners is that under that responsible investing umbrella, you do have a group of investors who would call themselves ethical investors, and they are typically associated with religious institutions. And from an ethical standpoint, they will have strong views on just negative screening. So literally screening out companies that might be involved in the production of tobacco products, alcohol products, pornography, nuclear weapons. And so I think that sort of bucket encapsulates ethical. Sustainable investors, I would say, are investors who don't necessarily want to just negatively screen, but indeed will take a more broad view and say, well, we want to basically weight companies in an index, or we'd love to have an ETF that does that, along environmental, social, and governance data factors. And so there's been a huge increase in the coverage of listed companies on those factors by companies like MSCI and Sustainalytics and Oicum Vigeo Iris. As you get those data points, you're able to build indexes which asset managers can then use, which asset owners can then use to not negatively screen, but weight companies, even say in energy, not based on market cap, but based on the factors from ESG. And so I would say that's more along sustainable. There's also a term that's used quite a bit called impact investing. And so impact investing, as the name implies, are strategies that specifically target outcomes, and typically around environmental outcomes. And so you have investors who very much want to lower their carbon footprint, so may invest in clean energy, solar, that type, or ex-fossil fuels. So I would say, it's a sort of an evolving landscape. A responsible investor is the umbrella, and then you've got sort of subsectors, if you will. And I think generally you've got people who are more ethically, who want a negative screen, people who are more sustainable and are happy to include different sectors with an ESG lens, and then investors are really looking at impact investing. The ETF, ETP industry has always had, one of the challenges has been the acronyms, right? The 3-letter acronyms that are associated around exchange traded funds, exchange traded products. And so people sort of joke, historically that there's an alphabet soup. So it may be, a bit more, there's going to be more letters in the soup, because if you think about 3 more acronyms, SRI and ESG, so you've asked me to define what those acronyms mean. They mean, on the ESG, it stands for environmental, social, and governance. And those are really 3 factors that when you're looking at responsible investing are sort of critical factors. And examples there, so an environmental factor might be carbon footprint. So that's a huge concern given the proven scientific evidence that we've got to do something about climate change. So reducing your carbon footprint, how much carbon output there is in companies, that's that data point you can grab as an E. A social example would be how companies relate to their labor unions and their employees from a diversity standpoint, for example. And then governance, so G, the big G, a lot of those data points tend to be around the board and independence of directors on the board. And so E, S, and G, it's almost become, in a way, a catch-all moniker for responsible investing. Or certainly one of the 3 key areas. SRI stands for socially responsible investing. And this is really the acronym that developed around, I'd say, the first index strategies probably 10, 12 years ago, which were exclusionary, right? And so these socially responsible investing strategies tend to exclude or negatively screen industries like tobacco, alcohol, pornography, nuclear weapons. And so we're going to have a bit more, when you put that onto ETFs, it just means you're going to have a bit more acronyms to work with. If you think about the types of investors that are using responsible investment strategies, I think it's, and certainly being passive in responsible investment strategies, I'd say it's a combination of institutional and wealth accounts that are using these. Talk to sort of friends and colleagues who are working directly in the index or ETF industry. They'll say that asset owners historically have done segregated mandates along these very bespoke benchmarks. So they were probably the first adopters of investment strategies, passive investment strategies. And one of the things that you hear on that side is that, well, if an investor had just exclusionary screens, right, so they were looking to exclude 3 or 4 sectors, a passive approach is incredibly efficient and cost-efficient way of doing that. On the wealth side, I think we've seen in Europe particularly an adoption of SRI indexes. And so UBS, for instance, on their ETFs, have just gone over $1 billion in sort of off-the-shelf, if you will, MSCI SRI indexes. And I think sort of the uptake there has probably been a lot of family offices and people who have been typically using maybe active funds, but have said, well, wait a minute, we can actually get our sort of environmentally friendly and social responsive screens within a cost-effective ETF. So it's a combination. I think from an asset standpoint, definitely the asset owners are going to have the bulk of the assets because it's been sort of bespoke, but where the asset owners go and what they care about means that asset managers care and will follow. And so I guess in a way the retail investors and the wealth investors, like myself, have the asset owners think to sort of leading the charge there. So there is a debate in the responsible investor community, and folks have really strong opinions, which is great, about whether or not a passive index strategy is really appropriate in the responsible investing space. And the folks that have that will challenge the use of passive and index in responsible investing say, well, if you are just taking a recipe from an index provider and investing according to that recipe, are you actually doing a second step? Are you actually being an active shareholder? And so in active funds, if you could own any stock and you could sell any stock. And so say, for instance, when VW had a diesel scandal, you could have just cut Volkswagen out of there and hopefully would have had it out of your portfolio before. An index portfolio, by its nature, is going to have those stocks in there. The screens that put stocks in indexes are typically quantitative screens. And so on the sort of the con side, responsible investor community people will say, well, that's not good enough. You have to get down to the next level, and in the case of Volkswagen, get very much engagement as a shareholder. Now, the thing with indexes is that they don't have to hold every stock in the index, and so I think we'll get to a point where the large indexers or the large index managers will be able to just as responsibly and proactively engage a company in their index fund as they will in their active funds. And so, it's not necessarily the case that an index fund also can't just sell that stock. And in fact, we've seen a case recently where the HSBC pension fund in the UK has worked with Legal & General on a future world fund. That is an index fund, and it's going to be a default option for HSBC employees in the UK, but they've given Legal & General not only the flexibility, but the mandate to follow stocks in that index, in their index fund, and if there are any significant controversies, be able to engage those companies, first of all, and more importantly, be able to disinvest from those companies. And so would the index, have a different performance than the actual fund? Yes, but I can see those two marrying up at some point, right? So you're going to have indexes, but managers and asset owners that say, okay, we are going to be responsible, and if there's a name or two in these indexes that have a significant controversy, we can sell it. And our shareholders are aligned that there will be mistracking, but they are very okay with that because we followed a path of sustainable and responsible investing. Providers of indexes and ETFs is growing, and so there's now about, if you look sort of globally, there's roughly about about $5 billion and about 60 ETFs that are using responsible investing indexes. Most of the major index providers have been and continue to launch responsible investing indexes. So MSCI, stocks, FTSE, Morningstar, and then even in the more custom bespoke world, there's a lot of work being done by Selective, and so most of the major issuers are working on those. From an ETF issuer standpoint, you see the bulk of the assets, by asset level, from iShares and UBS. Although other ETF issuers are certainly getting into this market, and I would expect to see the offering branch out from some of the bigger issuers moving on down. One of the more interesting, I think, ETFs that's come out recently actually is from State Street. So State Street has a gender diversity based ETF that's listed in the U.S. with a brilliant ticker, SHE, SHE. It's got almost 300 million in it now, and it's an index that weights companies by their essentially, how many women they have on the board and gender diversity, and so it's very much in the sort of social. I think we will also see more sort of niche index players in this market. One that is, I would highlight, I've seen a filing actually from Van Eck on a green bond index, which I think is a very exciting development. So major indexers in it, major ETF issuers are in it, about $5 billion, and would certainly expect to see those assets continue to grow. Right, so if we think about trading of ETFs, and so some people will ask, well, is there anything specific or different about an ETF that holds its benchmark to a responsible investing index? Is there anything we need to think about in terms of trading? So I want these strategies. What should we think about in terms of execution? And with the indexes or the ETFs that are based on these indexes, it's really no different than any other ETF in terms of trading, and the golden rules are going to apply. And so with any ETF, you're going to want to trade when the underlying market of those securities is open. And so if we are in London and we're looking to trade a US underlying ETF, you probably want to wait until the US market opens up so that the underlying is most liquid. I think in general, it's a good practice to use limit orders when trading ETFs and to try to avoid market open or market close when you can. For ETFs where you may not see huge amounts of volume, the mantra continues. You have to appreciate the underlying liquidity of the ETF is driven by the underlying liquidity of the stocks and not the volume. If you were looking to trade an ETF on an ESG or SRI benchmark, if your trade is going to be more than, say, 20% of the average daily volume, I would say definitely contact the ETF issuer, have a chat with their capital markets desk, and they can put you in touch with brokers that are going to be able to facilitate trades that are much, much deeper than the volumes you see on exchange. So for people who are looking at synthetic versus physical ETFs, I would say in the responsible investing space, either is an efficient way to get index exposure. One of the considerations with synthetic ETFs is, as you'll probably know, is that synthetic ETFs hold OTC derivatives to get the exposure for the index, and then will either hold a collateral basket or post-collateral to fund those swaps. One of the things to note with some synthetic ETFs is that the collateral basket could be very, very different than what the actual index is. And in fact, I've seen a case where an index ETF, which is benchmarked to a low carbon index, actually wound up holding, if you looked at the fund's holdings, it was a synthetic ETF, it actually held Volkswagen in the collateral basket, which is probably not consistent with the sort of spirit of what the investor was trying to do. So either synthetic or physical ETFs, perfectly good forms of replication. Just note what is in those baskets, because that is what the fund holds, and for certain synthetic ETFs. And if you look out sort of 12 to 24 months, are a couple of trends or themes that I would see. The first, I think this is really exciting, is the crossover and a sort of marriage, if you will, of strategic beta, smart beta indexes, factor indexes with responsible investing index. And so what I mean by that is that you have, a growing amount of use and research and development of essentially, indexes that are based on factors. So dividend, minimum volatility, value, size, these sort of standard quality, these sort of, standard factor exposures that have become very popular. If you think about marrying that, so combining that, and let's just say with ESG factors, it becomes quite exciting. And so for people who are buying Minvol or dividend ETFs, if you then also overlay ESG on that, you're not only getting your strategic beta, but you're also getting your sort of ESG and responsible investing lens. And I think there are filings in place, especially on the dividend and Minvol, that also include screens for ESG. So that's one. I would say in the asset owner space, I think what's happening is that asset owners, particularly in Northern Europe, who probably have mostly switched to responsible investing type benchmarks, that activity and that behavior is going to be, you're going to see that in more pension funds and asset owners. They may have their policy benchmark, which is conventional, but I do think they're going to start looking at more responsible investing benchmarks. When asset owners move, asset managers follow. And so also on the asset management side, I think that we're going to see more, hopefully, more demand for ETFs based on responsible investing indexes. In Europe, I think there'll be more growth in the sort of the exclusionary. That people, at least for now, the flows have tended to be in the SRI exclusionary. So I'm assuming that's going to stick. In the U.S., it's interesting. I think there's going to be actually more growth in the sort of ESG or inclusionary type products.